From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, the Powell pushback. The central banker keeps rate hikes on the table. Plus, short-term yields went back on a tear, fluctuating around 5%. Then, problems for the long term with the 30-year auction gone wrong. But we begin with the big issue, the market versus the Fed.
Listen to what the Fed says.
The Powell comments
were kind of a slightly more amped up version of what he's been saying for a while.
Reiterating what he said all along.
The sort of pivot into much more hawkish speak.
Yeah, the recent data have been good, but they're not yet definitive.
They're focused on inflation. They're focused on the jobs data.
They're very nervous about declaring victory and then having to undeclare victory.
The market needs conviction that the Fed is really done.
The market continues to disbelieve this higher for longer.
The Fed is moving off center stage.
Right now, nobody has any idea what the bond market's going to do.
There's still a lot of underlying tensions in that bond market.
There's still really a good chance that we're going to see a lot of volatility.
The Fed is going to have much less of an influence on where rates go from here. But unfortunately, that doesn't mean that the volatility is going to go away.
We first start by looking at that 2-year yield, because what a long way we've come. When you look back in March, we were at 376, and we have gone more than 60, 70 basis points higher, and we have been flirting with 5% all year, including at the beginning of the year, and we're back there now. Even in recent weeks, you have seen a lot of fluctuation around that 5% mark, dipping below, but back up today to about 504 on the heels of a lot of comments by Fed Chair Powell. Now, if you flip up the board here, you see the volatility at the short end was more pronounced relative to long end earlier this year, and the whipsawing was drastic. This yellow bar here is the 2-year yield, and back in March, February, you have seen 80 basis points moves lower or 60 basis points moves higher, and now we're really looking at that move in the longer end of the curve being more pronounced. Now 60 to 40 basis points in either direction for that 10-year as well. We saw even more volatility after Powell said this.
If it becomes appropriate to tighten policy further, we will not hesitate to do so. We will continue to move carefully, however, allowing us to address both the risk of being misled by a few good months of data and the risk of over-tightening.
And joining us now is Gennadiy Goldberg of TD Securities and Ashok Bhatia of Neuberger Berman. Gennadiy, starting with you, if you look at that volatility in the short end versus the long end, are you more concerned about the short or the long end when you're thinking about financial conditions?
I'm now concerned about more the long end, because I think there's not as much debate about what the Fed's going to do in the short term. You've got, the Fed already raising interest rates. They've basically said they're probably done, maybe one more, maybe two more, but really we think no more. On the long end, it's becoming a little bit more toxic. You've seen this massive rise in rates, and that's actually created a lot of losses on bank portfolios. It is tightening financial conditions by tightening up bank credit as well.
What's interesting about that, Ashok, is that if you think about the control the Fed has over the short versus the long end, do you get concerned at all about what is driving the long end higher in terms of rates?
Yeah, I think the things that are driving the long end higher are, the supply that's coming, the Fed's, taking less duration onto its balance sheet. And, that will be a continuing theme. And as we all know, the federal government is issuing more and more debt that the private sector has to buy. And so those types of dynamics are outside of the Fed's control. The Fed could even come out here and promise us that, policy rates aren't going to go higher and give us certainty on the policy path, the 2-year notes. But some of these issues that are driving intermediate and longer yields would still be there. So agree that the tightening of financial conditions being driven by the longer end is really the key macro event right now.
And Ashok, with that kind of volatility, how do you position trading? Is it a duration play here, or is it a matter of capturing yields where they are?
We are capturing yields where they are. So, investments in the 2 to 7 year type of maturity in the Treasury space, those types of maturities in the mortgage market, investment grade credit markets. We could see another hike. It's not our base case. But these types of yields, at some point, whether it's a year from now, 2 years from now, 3 years from now, policy rates will go down at some point, and the market will be well ahead of any Fed ease. And so, we've reached the judgment that it's now time to do a little bit of duration extension.
Now, I want to point out what Katie Kaminsky of Alpha Simplex said earlier this week about the potential for shorting some of the parts of the curve.
We're still short. This is because for trend following, it's not just about a couple of days. It's really about persistent trends in the market. We've been saying short, short, short all year. And for the first time, it's starting to feel like we already got that short come through. What's next?
Seems like a brave trade. How do you feel, Gennadiy, about how that can play through into the market? Would you go short at this point?
I wouldn't. Actually, we went long in our model portfolio just late last week, or I should say middle of last week. So we're still doing okay on that trade, but it is a lot of volatility right now. And, I think that's keeping a lot of investors away. And then, I agree with the earlier comment about, trying to play that duration, trying to capture that. But a lot of clients are very paralyzed about the next 3 to 6 months. Everyone knows that eventually there'll be a slowdown. It's just a question of when. And if that slowdown takes another, goodness forbid, let's say year or year and a half to actually hit, then it becomes a big problem because you can be holding on to losses for quite some time.
I'm going to ask you the same question I asked Ashok, which is how do you start to position at this point in the cycle?
I think you want to be exposed to that 2 to 5 year part of the curve. I would say even shorter than the 7 year. 7 year is a little bit tricky because of supply. The 2 to 5 year point is the more exposed point to Fed rate hikes. And, as you pointed out, less volatility there compared to what we saw, for example, in March. March was more volatility than we saw even in 2008. So you really want to start to kind of chip away at these very attractive longer-term rates. But again, the question is what's going to be the catalyst? I think it has to be the data starting to turn over.
Speaking of data turning over, I had a conversation earlier this week with Mark Spitznagel, the founder of Universa Investments, and he had talked to me a little bit about how he thinks that rates can actually go much lower. He said, this is my own crazy theory. I think rates are going back to zero as well. I mean, a lot of people would think I'm nuts. Ashok, do you think he's nuts?
I would never call anyone nuts, but I think seeing 0% is, it's hard to see. I mean, 0% is saying effectively we need to be negative real yields, on a policy rate again. And that seems a hard stretch. And I'd say the main reason for that is I think the political dynamics around QE and this type of very aggressive monetary policy has changed. I suspect the political support for the Fed going back there, absent a real crisis, is going to be a lot more limited than it's been in the past.
Right. The reality is if we were to get back even to cutting, it could be either that the Fed has done its job or that the economic data turns. What do you think, Gennadiy, happens first?
So I think the data turns first. I think the data has to be the big driver of everything, unless, and I think this is where, I wouldn't call anyone nuts as well, but, unless there's a big crisis. And if there is a big crisis, then everything is out, kind of off the table. You can go to 0%, but it really is something the Fed wants to avoid this time around compared to last time. They realize they overdid it. They won't certainly admit it, and I think that's going to be a long-term strategy for them. But look, unless something terribly breaks in the system that requires them to step in with QE, that requires them to go to 0% interest rates, that's not their baseline. They're also worried about inflation re-accelerating, right? Remember, inflation's kind of like a tinder. If you don't put it out fully, it will reignite. And I think that's what they're worried about most for now.
How big of a risk is that? And how big of a risk does that mean for higher short-term yields as well?
So, if I look at the Fed's own forecasts, I'm just thinking about this recently. The one inconsistency in their forecasts is that there's really no pain. We don't get growth negative. We don't really get the unemployment rate higher, but you get inflation kind of magically coming down. That's the one weak point of that forecast, that if inflation actually doesn't come down, they could be in trouble. They might have to basically kind of push on a string and keep taking us higher and keep kind of ramping up those financial conditions even further.
Now, another interesting aspect of this conversation with Universa, and Ashok, you started to hit on it, is quantitative tightening. And the Fed's balance sheet really has not been reducing itself meaningfully. Do you think that the Fed will have to provide more support to the market at any point in time? Or do they have to keep the direction of travel such that they are still quantitative tightening?
Yeah, and we think it's very difficult for the Fed to change its QT policy here. So, as you correctly noted, the The Fed balance sheet reductions have really been pretty modest so far. There'll be a bigger impact into the markets next year. But the hurdle for that is to change that, I think, is pretty high. So I think we should assume that's sort of on autopilot, at least for the next 12 to 18 months. And, longer term, there's plenty of arguments that the Fed will need a larger balance sheet, and we'll see how those play out. But I don't think that's an immediate investment question.
How much does it tighten financial conditions on top of higher rates?
I'm sure, we've seen estimates, 25 basis points, 50, there's some estimates out there that it's worth as high as, 3 hikes. I think thinking about this as something worth 25, 50 basis points seems reasonable. I would say, I think, you are seeing the impact in things like the mortgage market where, with the regional banking system, the REIT system, and the Fed, those have been 3 really large buyers of these assets since the financial crisis. And I think the Fed's, not reductions in this area, it's something that's been contributing to, relative weakness to other asset classes and fixed income.
But what's amazing is that you still see household credit starting to grow, particularly in credit cards. There are other areas where there's obviously loan weakness. But Gennadiy, do you think here that the lagged effects have not been seen when credit is still flowing in this economy?
I think you're absolutely right. We haven't really seen it yet. We're only starting to see it now on the pickup. You've seen the report from the New York Fed earlier this week talking about delinquencies in credit cards, in auto loans, even in mortgages, believe it or not. I mean, they're coming off of very, very low levels, but they are starting to come up. So, higher interest rates bite, and they take a little bit of a while to actually pass through. Certainly the mortgage market tends to be the first one. But we're now seeing it in credit card delinquencies. We're seeing it in auto delinquencies. I think it's going to keep biting. I think we just have to give it a little bit more time.
It's a great place to leave it. That's Gennadiy Goldberg and Ashok Bhatia. We thank you both for your time. And up next is the auction block, which was an extremely active week with companies selling fresh bonds. We'll get the details ahead. This is Real Yields on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where we saw the continued surge in investment-grade issuance this week. In the United States, we had 30 companies generate nearly $44 billion in sales, topping estimates. You had names like VW, Charter, RTX, Roche, and Enbridge all selling debt. The surge wasn't just in investment grade. You had a rush in high yield as syndicate desks were issuing new debt after funding costs dropped just a little bit. Notably, Spirit Aerosystems sold $1.2 billion. And the return of AT1 bonds. UBS pulled in roughly 10 times the bids on debt for offer. It sold 2 dollar-denominated bonds for $3.5 billion in total, which combined orders of more than $36 billion. And speaking of UBS, its CEO spoke this week at the Bloomberg New Economy Forum. He told our Francine Lacroix that clients are attracted to fixed income.
Higher rates have shifted the asset allocation thinking of clients back to a more traditional heavy component on bonds, on basically people are saying with 6.5% kind of yield, 7% even with pretty good quality, do I really need to have risks, and that has changed. And but it's a reflection of both risk aversion, but also the attractiveness of fixed income.
And joining us now is Daniel Zwirn, CEO of Arena Investors, and Andrea Di Censo of Loomis. Thank you both for joining us. Dan, when you think about kind of the cracks in the market, even the safer of markets, we're seeing so many investors pile more into investment grade, excited about the yields, thinking they're safe. But then you have the likes of DoubleLine saying, no, we're going to even be specific in those markets, worried about places like regional banks and others. Where even in the safest markets are you worried?
Well, I think part of the issue is it's really a bond-by-bond selection issue, right? And so the nature of the investment grade market is it's very focused on coverage as well as defaults, when it really should be focused on leverage and severity. And so there are a lot of distortions in the market in the way that the agencies look at things, such that you need to look underneath the hood. So as an example, in a bank, you might have an unsecured bond with an investment grade rating at the very top of the very bottom of the capital structure versus something that might be in a mortgage REIT where you might be secured and senior right, starting at the top of the underlying assets. So it really requires you to not just be the market, but rather pick through it, again, one by one.
Speaking of, Andrea, when you look at the delinquencies so far, what is the data telling you about where things are starting to deteriorate?
What we're most concerned about and watching most closely is really centered around the consumer. Your previous guests really hit on some of those talking points. It's increasing credit card delinquencies, some concerning signs around mortgage delinquencies. And when you look at the overall financial tightening that we've seen flow through the markets today, the consumer is not able to spend at the same pace that you were able to just 18 months ago. So as we look forward, and you saw this highlighted this morning on some luxury earning reports, consumer spending, even at the top tier, is falling. And that is a number one concern for us because the consumer makes up over 2/3 of global GDP. So as you start to see them pull back on spending, that's going to have much broader implications, not just to average credit quality across the investment grade market, but it's also going to have much more severe consequences within the high yield and emerging market space.
Now, when you think about those cracks you're starting to see in the consumer, mortgage, even credit card, how much more pain, Dan, do you think there is to come? And how are you thinking about it from where you're sitting?
I think there's quite a bit more to come. Those delinquency numbers have already been rising in the last several months. The issue is, how does that get priced into the market, or how is it shown to the market? And what we've seen since the GFC is there's a lot less intermediation of bonds and a lot of other methods by which people thwart price discovery. So as an example, if you're a financial institution, you may not have to run the loss through your income statement. If you don't actually sell the bond, it only goes through your balance sheet.
Now, it's interesting. If you're an investor in these markets, do you wait for peak distress, Dan, to get in?
Yes, because the answer is there's a fire somewhere, always, right? And so since the beginning of the blow up of the everything bubble in late 21, sequentially you've seen things kind of implode to, roughly in order of the degree to which they're subject to a cash miss or an asset liability mismatch. So you've seen growth, then funds, then CRE, now leverage finance and direct lending. And I think in 6 to 9 months, you're going to start to see it in structured finance.
Now, Andrea, before we get to more of this distress problem, question for you about where you do see opportunity in investment grade or even high yield, if you think about the ability to capture yield at these levels.
Sure. I think, thinking about the shape of the overall curve and where that shape of the curve is going in the next 6 and 9 months is really going to help you think about where you want to be taking risk and where are you able to monetize that credit risk premium. Now, you've seen the most volatility in rates really building in the back end of the curve. We've moved from a bear steepening environment to what tends to follow bear steepening, looking back historically even to the 1990s, is a bull flattening environment. So as we think about where we're going to find opportunities in investment grade, we are looking in the triple B space, looking, at some potential opportunities further out the curve. We've taken advantage of the front end, shorter duration plays, and now we want to be thinking about that segment. Within high yield, you still want to be cautious triple Cs at this point in the credit cycle. We do believe that defaults are likely to continue to rise. And as such, we've already seen a double-digit return in triple Cs. What about single Bs, high quality single Bs and double Bs? Those were punished with the rate volatility that we saw. So we see a lot of opportunities in that space in the coming few months.
Now, speaking of the everything bubble and the idea that defaults are rising, perhaps the poster child of that was WeWork. This week, Jim Caron of Morgan Stanley reacted to how that might just be a harbinger of things to come.
This is an ongoing issue. Some people refer to them as zombie companies that have really existed because capital is cheap, interest rates are low, they could borrow and they could debt finance. When rates are 5.5%, your hurdle rate for investment and return on investment is a lot higher. So I think what we're seeing is the growth pains of these higher interest rates, where you're going to see more highly levered businesses that maybe weren't run as efficiently or didn't term out their debt as they needed to, are going to face a very, very stiff headwind.
Now, WeWork, of course, is an extreme example, but it was really reminiscent of a time where people were borrowing money for nothing and not making enough in return. How much more, Dan, do you see problems like mini WeWorks stepping into the surface?
I think there's a tremendous number of them. And in fact, relative to the opportunities between IG and other securities, I think there's a great opportunity if you're a credit arbitrageur to be long IG, short high yield, or long IG, short EM. And so what you want to be is effectively position that way to be long put optionality, and then come back in, and once they're busted, and once the various ways that people thwart price discovery break, there's opportunities that are busted, but it's not there yet.
And Andrea, do you also see that there are more kind of problems under the surface here, perhaps more that meets the eye?
We believe that there are certainly problems, but you really have to sharpen your pencil and do your fundamental analysis here, because there are a lot of companies that have already turned out their debt. They don't need to come to market, and their balance sheets are in a much better position today than they were 24 months ago. This current default cycle is unlikely to look like the past default cycle because of the improving credit quality of the high yield market. Therefore, we think many of these corporations within the high yield space, specifically more tiered around that double B area, are able to absorb some of the losses that you might experience and still turn out okay and achieve really attractive single-digit returns.
We have to leave it there. Daniel Zwirn and Andrea Di Censo, we thank you so much for your time. Still a little trouble ahead, but opportunity too. Now, still ahead, the final spread, the week ahead, another key inflation print. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up Tuesday, a lot of consumer price and producer price data. Tuesday is U.S. CPI plus Home Depot earnings, and Wednesday is U.S. PPI and retail sales. Thursday, another round of jobless claims plus earnings results from Walmart, Macy's, and Gap. At midnight, Friday is the U.S. government shutdown deadline. And for my final thought, let's just take a look at what is expected for inflation. We have a CPI year over year expected to cool to 3.3% from 3.7% a year ago. Core to stay flat. The expectation month over month for core, so CPI to cool quite meaningfully to 0.1% down from 0.4% the month prior. But remember, core CPI is expected to stay just about the same. Now from New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.